So, what does this all mean to you? What does the property management basics mean to you? I think for a lot of us, we're looking at all these things. The reason that you got involved in real estate as an investment is one, if not all of these things. The first thing is monthly income. I think you all should be by now be geared to understand operational income, operational expenses, NOI, all the way down to cash flow. You want to bring the money in because that puts the food on the table, clothes on the kids, gas in the car. Appreciation. I think you should also be concerned with driving the value of that asset. If it's a single-family house, you're going to change what that house is being compared to. If it's an apartment building, you're going to drive net operating income. Those are your two main focuses on appreciation. Remember, as investors, we are after forced appreciation. Natural appreciation in a healthy market is going to happen normally. But we should be asking ourselves, what can we do on purpose to the asset to drive its value? Number 3, tax advantages and depreciation. Real estate gives you tax advantages, there's no doubt. As I gave you the example yesterday, on that depreciation example, you're going to have so much money that you're going to be allowed to make that is going to be tax deferred. Not going to be taxes on that in that year. They're going to be deferred. I would take as much advantage of that as you can. So make sure that if you're managing the property or your property manager is managing the property, that they know that one of the reasons that you want to maximize cash flow is because a good part of that or a portion of that is going to be tax deferred income. We don't get that a lot in revenue that we bring in. Your net worth is also going to be important. Having your net worth and understanding the opportunity to not only drive the value of your asset, but raise your net worth. Remember, net worth is derived by taking the second part of your personal financial statement, which is your balance sheet, and you take your assets minus your liabilities, and that will give you your net worth. How much you're worth on paper has everything to do with how much you can drive the value of your assets. Okay? Business. This is a business. Investment in real estate is a business. Property management is a business. You and or the property management company that you hire has to have good business practice. You've really got to make sure that you are doing things in the right fashion. You know, how is the accounting handled? How is the management handled? Because it's rental real estate is in such high demand, are you enforcing things like late fees? That's a management issue. You know, some people might say, well, you know, they're really nice and I'm going to let them slide this time. If you let tenants slide, you're training them to pay rent late. Okay? And then finally, leverage. One of the reasons that I got involved in developing my own property management company was the fact that, as most of you know, I'm not really good with working with tools. So a few trips to the urgent care clinic, and I realized that I needed to hire a maintenance person. So that was my first hiree. I would recommend utilizing leverage in property management, just like you're doing with all the other aspects of your real estate investing. You're adding leverage. I think that's important. I think it's something that must be done. That would be a question also that you want to ask a property management company when you're hiring them out. Okay? Any questions? We need you at the mic if you got. Okay, just another management announcement here. If we do have a question or comment, we really need you to go to the mic because we have it recorded. I heard that one, I'll repeat it. Just go over that again with leverage is what his statement was. I know what it's like, man. I have trouble following the rules sometimes as well. I know. Leverage. You've got to use leverage in property management. As a matter of fact, another example of that would be the example of implementing leverage in your lease. I think that structuring a lease in which it says the rent is $9.50, but if you pay me by the 5th of the month, you get a $50 discount. That's implementing leverage in your property management. That would be an example of that. I think you should continue to do that throughout your property management strategies, okay? Remember, leverage is accomplishing a lot with very little. Accomplishing a lot with very little. So you're going to be using leverage by using other people's time, perhaps, in the way of the maintenance person, knowledge, money, that type of thing. Resources. Question?
Something that's always kind of intrigued me is the difference between appreciation and inflation. If you could just sort of explain that, because buildings tend to decay and become rubble, and yet you've got appreciation up there.
Yeah. Appreciation, look at it like this. It's the increase in value of your asset over time. Inflation is more of a monetary description of where it takes more dollars to buy the same exact thing. So as inflation, now there's a direct correlation with inflation in rental real estate. As inflation starts to creep up, a hedge against inflation is rental real estate. Why? Well, as it takes more dollars to buy goods and services, and the increase in price of those goods and services go up, so do rents. So as your rents go up, you're able to buy more goods and services, and it acts as a hedge. So there's a relationship there, no doubt about it. No doubt about it. You good, Gavin? You had a question? Okay. So this is really how important your asset or your property management is. I really think that you all should be looking at property management is the thing that's where the rubber hits the road. Anything you think about with regard to your investing, putting cash flow in your pocket, driving the value of your asset, and then refinancing that, taking that money to buy another asset, all of that comes down to property management. And if I was going to develop a company, I would focus on that aspect. Net operating income. How much money you're going to put in your pocket at the end of the day with cash flow. And finally, what is the value of your asset and how I'm going to drive that over the period that I'm managing that asset. So, let's talk about you becoming kind of the CEO of your property management firm, or if you're managing the property manager, which a lot of you are going to be doing. I want to kind of go into that a little bit. There's three things that I think play into that. Number one is vision. Let me kind of tell you what I'm talking about with that. I read an awful lot about the real estate market. One of the reasons that I read an awful lot about the real estate market is I want to judge things like demand. I want to judge things like interest rates. I gave you an example earlier that if you've got an interest rate that is adjustable, meaning that goes up or down based on what's going on with like the 10-year Treasury or LIBOR, which is a rate that comes out of London. Well, you as a property manager have to kind of have vision with that. I really feel that over the next year, that inflation is going to start to creep in more and more. So that previous question that we got about how does inflation relate to appreciation and your properties? Because I feel inflation is coming in. By the way, let's define inflation. Inflation is too much money chasing too few goods and services. Too much money chasing too few goods and services, making the price of those goods and services go up, right? There's too much money in the system. And you've probably seen that from all the stimulus programs that you've heard about and low interest rates. There's a lot of things that causes that. So to combat that, in the States, the Federal Reserve comes in and they say we've got to limit the money supply that's out in the marketplace. What's one of the ways they do that? Anybody know? They raise interest rates. I really think that this will start to happen towards the end of 2012. The reason being, of course, we're going to have an election. And after that election, things start to happen that normally don't happen up until then. So if that's the case, and this is just an example of how I use vision, but if that's the case, I know that it's imperative for me to raise rents on my tenants. I've got to look at things like supply and demand and things like that, but I know that that's the main reason I want to raise rents, because I feel that interest rates are going to start going up. And if we go back to this slide here, and we go to this flow, eventually, this thing flows down to where I've got to be concerned with debt service. If my debt service is going up and my income is staying stagnant, my cash flow goes down. Does everybody see that? Now, if my income goes up and my debt service goes up, my cash flow stays the same. However, this is a perfect world. This is where I'd like to be. I want my income to go up. I want my expenses to go down. I want my debt service, I'd love it to go down, but if it does go up, I'm probably still going to make more cash flow. Does that make sense? This is exactly the form that I go back to every time I'm thinking about how I'm going to manage the property, how I want my property managers to manage the property, and I'm getting an overall strategy. I'm studying these things in my due diligence. So with that aspect, knowing that interest rates, or having a good feeling that interest rates are going to be going up towards the end of 2012 into 2013, and knowing how important it is to raise rents, I've got to ask myself the question, number one, what is the demand in my marketplace to do that? And number two, what is the absorption? I want you to write those two words down, demand and absorption. What is the absorption of my tenant base in which they're going to be able to afford a rent raise? Because it gets to the point where there's eventually a saturation that happens, where they can no longer afford an increased rent. You want to have vision to kind of understand where that is. Let's go back to our example of a $900 per month market. Let's just say that the demand is high, which it is in pretty much all of the metros today with regard to rental housing. The demand is approaching 93, 94, 95%. When you start approaching that mid-90 range, that's a very high rental demand. I think on average right now, it's about 92% and growing. So when you have strong demand like that, it tells you that, yes, chances are you can raise rents in that marketplace. You have to do something that's called a market rent survey. One of the reasons that I ask all of you to consider your competition in a marketplace is because you're going to be going, to that competition and finding out what they're charging in rents. You want to know what they're charging for the same amenities that you're offering to your renters. So let's say that you find out that your market is charging $936 and you're charging $900. You know that you're about $36 or 4% below market rents. The next thing you need to ask, specifically to your tenant base, can your tenant base afford a $36 per month raise? Usually when demand is high, there's more of a chance for that. So what I would do is look specifically to it, whether you own a single-family house, a 10-unit building, or a 200-unit complex. $36. In the tenant's mind, is that enough money to decide to move from there? $36 a month. Depends on your tenant base. But those are the questions that you're going to have to ask. But back to the vision thing, that's the vision that I think you need to put in place. Right now, rents are definitely going up. I would say it's very close to that 3 to 4% increase per year. The other thing that I do, and you'll see this when I show you a copy of a lease that I use, is that I'm already thinking about that rental increase the moment they sign the initial lease. There's a statement in my lease that says something like this: 45 days prior to your lease expiration, you're going to be getting a notice from us. And in that notice, it's going to ask you whether or not you're going to be staying or you're going to be leaving. If you're staying, great. We're going to get you out a new lease or a lease addendum or a lease extension, but your rent is going to be 3 or 4% higher than this current term. So they already know that going in. If they decide to leave, we want to know that within 2 weeks, so we have a full 30 days to find another tenant to put in that unit, assuming there's nothing wrong with the unit. But the reason I'm doing that is because it goes back to this vision topic here. As the leader of your property management company, I am telling that tenant almost a full year before that their rent is going to go up by 3 to 4%. Okay, so they don't get hit with that towards the end of the lease. And typically they understand that. I think good communication to tenants is important, and you'd be surprised. Tenants know that, you know, gasoline prices are higher, utility costs are higher, food costs are probably higher, and inflation is starting to creep in. They almost expect rent to go up. Now again, you've got to look at that absorption rate. What rate could your tenants absorb? Now you might say, well, you know, my tenants could absorb a $36 per month increase, but they probably couldn't absorb much more than 50 or 60. You want to get a feeling for what that is, okay? That's kind of the vision type thing with that. The second point there, on the leadership side, this kind of comes down to this. You might have a tenant in your single-family house or maybe your apartment building in which they're a little bit older. And let's just say that they're struggling with their rent payment. They live in a 2-bedroom apartment unit, and they're not able to come up with the rent. They're struggling with that. So leadership might be making a decision on what to do. Instead of evicting that tenant, they've been there for a long time, they're a good tenant, they don't cause trouble, they're just having a little financial challenge. As a leader of that company, you've really got to make sure that you're making decisions as a leader. For instance, in lieu of eviction, because she's older, because she can't afford the rent, how about making the decision from taking her from a 2-bedroom apartment and maybe putting her into a 1-bedroom if you have one available, or if she's not in a single-family home. Or maybe there is some kind of rent subsidy, like a Section 8 or HUD that tenant could get on, that they would come in and subsidize the rent. You might be a leader in that way in showing her how to apply for that program. Or maybe there is some utility assistance. She may not be able to afford the rent because her utility costs are too high. So maybe there's some utility assistance that she could get from the government to be able to do that. Once you know you've got a good tenant, they don't cause trouble, they typically pay their rent on time, and with the exception of this last few months of financial issue or challenge, but you want to keep them if you can. Tenants that stay are going to give you an opportunity to reduce turnover. Turnover creates expense. So when we go back to that flow, income, expenses, NOI, so on and so forth, if you can reduce your turnover expense, you'll increase your net operating income. Does that make sense to everybody? And ultimately increase your cash flow. The final thing here is enjoyment. You've got to find a way to enjoy property management. You've got to find a way to enjoy managing your property manager. This is your investment. I love real estate. I love everything to do with real estate. I love walking through real estate. I love dealing with people on leases and applications and things like that. You've got to find a way to enjoy what you're doing. I would challenge you that if you don't enjoy what you're doing, you're going to have to make a change. And that probably backs to this leadership thing. We took a little bit of a personality test yesterday. And some of us are probably better geared to the detailed end of things than others. That might be the person that you need to implement on your team that handles leases, applications, making sure the rent is in on time, that type of thing. Other people are probably better at the big picture thing. Hey, what can we do with Mrs. Jones because she's struggling to pay her rent? What ideas can we come up with to keep her as a tenant but make her financial position a little bit better? Does that make sense? Utilize your skill set in property management. I think a lot of people, if they did a little bit more of that, they would find out that their property management would be a little bit easier and they would enjoy it a little bit better. Okay? So I would really recommend that. There's three approaches. Three approaches that people take with property management. The first one is this. And we're going to pause because we got a question. Yes?
An absentee landlord, you're in Canada. How do you manage those kinds of things on like a 10% fee to your property manager? I mean, it seems like a lot of things, you know, everyone's trying to do. How do you manage that when you're not there, really?
Yeah. So because you're in Canada, you're going to have to manage that property manager. If you're talking about a single-family house, that property manager is probably going to charge you in the realm of 10%, or sometimes it's a flat fee, whichever's greater. And I think because they're in the property management business, they've got a team of people, so they're not just managing your property, they're managing hundreds of units, so they're adding leverage to that. That's how they're able to do it for such a low, you know, you would think 10% on a $900 rent, that's $90 a month. It's actually not too bad a price, but when they've got hundreds of units that they're managing, they're actually bringing in quite a bit of money. So they're using that same idea of leverage as I want you to use. There's no doubt, property management is tough, but once you get it set up as a system, it becomes a little bit easier, okay? Any other questions? We're good? Okay. Number one, you could run the property yourself. Now, because you're in Canada, that's tough for you to do. Although I have had some people tell me that they're going to do that. I wouldn't necessarily recommend that because of the distance. There's no worse feeling than having something wrong with your property and you're thousands of miles away and you're in another country. Okay? I wouldn't necessarily recommend, you talk about lack of enjoyment, there's a quick way there by managing the property yourself. If for some reason you spent 6 months or 5 months and 29 days in that area and you wanted to do a little bit of that to gain some experience, okay, I could see that. But I normally don't recommend that for people. There's some people that want to get involved in real estate investing and they'll say, listen, nobody can do this better than I can, right? I'm not going to hire someone else to do this when I can do this myself. I can find a tenant, I can fix the stuff, even being in Canada, I can make that happen. You're going to run into some challenges that I don't think you're expecting. So I don't necessarily recommend that, with very few exceptions. Number two, create your own property management company. Now there's a thought. You create an entity, you're actually in Canada, but it's an American entity, and you hire somebody part-time or full-time to manage your property. I would say if you're going to do this, make sure that you've got a few units under your belt. I wouldn't necessarily recommend this for 1 or 2 houses. But if you're buying apartment complexes or smaller apartment buildings and you've got a few of these, this might be the way to go. Now, the difference between the second one and the first one is this. Whenever you sub the management out to a third party, like I guess the third one that we're going to talk about here, there's always a risk of subbing it out to a company that doesn't have the same priority that you do in managing your property, number one. Number two, because they're managing hundreds of other units and you've got a prospective renter that comes in the door, what's the priority of getting your empty unit rented over somebody else's? So I want everybody here to be cognizant of that fact. There's a little bit of that happens. You've got to take that as somewhat of a risk analysis and know that a little bit of that happens and you're going to have to absorb that a little bit. So there is a little bit of control that you're able to get in creating your own property management company and having a person work for you part-time or full-time. You know, there's always a priority to get your unit rented. Thirdly, and we kind of just briefly touched on it, farming it out. You're typically going to pay in the realm of 8 to 12%. Sometimes if you've got a large apartment complex, you're going to have a lower percentage than that, 5%, 4%, 6%, somewhere in there. But for most of you, you're going to be somewhere in this 8 to 12% range. Now, I get this question a lot too. When I sub it out to a third party, John, I've got this house and it's in Orlando, Atlanta, Chicago, St. Louis, wherever, and the property manager wants to charge me the first full month's rent, and then they're going to charge me 10%. Is that appropriate? I'll get that question a lot. Well, it could be. I think you've got to find out what is traditional in that particular market. Remember that property management and everything to do with real estate investing is negotiable. You probably bought that house by negotiating. I would negotiate your property management price as well. You don't get if you don't ask. So when somebody comes to you and says, hey, I'm going to charge you a full month's rent to find the tenant and market for the tenant, and then I'm going to charge you 10% a month, I would say to them, you know, kind of set it up this way. Well, how do you market for tenants? First question I would be asking. They're going to tell you the web, Craigslist, signs, bulletin boards at grocery stores, whatever they're going to tell you. And then I would say something like this. Well, don't you guys have a system in place where you have an inventory of tenants? I would think that, you know, as a big property management company that you are, that you already have that in place. You're setting them up for the negotiation of, oh, well, great. Since you have that system in place, I think giving you a full month's first month rent is a little high. Could we knock that down to a half a month's rent? You see, you're setting them up by the questions that you're asking. So I would always try to negotiate the prices that you're being charged. You did that going into the real estate investment. I think you need to carry that trait on when you're negotiating your property management contract. That's the other thing that we're going to be going over is the contract that you're going to have with the property management company. I'm actually going to show you one that I use that I'm going to go through each line item and I'm going to show you, and this contract, by the way, was written in the favor of the property management company, and I want to show you why that is, okay? So you kind of get a bird's eye view of what they're looking at.